Hey everyone, ever wonder why the stock market feels a bit shaky sometimes? Or why the news keeps talking about the US debt? Well, today we're going to break down how the government's growing debt directly affects your investments. It's simpler than you think. Let's get straight to it. The United States government owes a lot of money. We're talking over $36.2 trillion right now, as of May 2025. Imagine a giant credit card bill that just keeps growing and growing and growing because the government keeps spending more money than it brings in from taxes. Now, this huge debt isn't just a number. Big rating companies, who are like financial report card graders, are getting worried. For a long time, the US had a perfect AAA credit score, but not anymore. First, S&P lowered it in 2011, then Fitch did in 2023. And very recently, in May 2025, Moody's, the last big one, also lowered its rating for the US. Why did they do it? They said the US government is just not spending responsibly. They highlighted persistent large budget deficits, meaning we keep spending too much year after year, piling on more debt. This is a big warning sign to the rest of the world. So how does this affect your stock market investments? It all comes down to interest rates. When the government needs to borrow more money, especially with its credit score dropping, it has to offer higher interest rates to get people and countries to lend to it. Think of it like a desperate borrower offering a better deal, and that's what we're seeing right now. The interest you can earn on safe government bonds is going up, like the 10-year Treasury bond now paying around 4.45%, and the 30-year bond nearly 5% in May 2025. When you can get a pretty good, low-risk return from the government, why take bigger risks in the stock market? This makes stocks less appealing, which can push stock prices down. Also, businesses find it more expensive to borrow money, hurting their profits. And here's a really tough part. The government has to pay interest on all that debt. This cost is becoming huge. Right now, paying just on the national debt is costing more than what we spend on national defense or even Medicare. That means less money for roads, schools, or other important things. So what should do about it? Don't panic. While this debt crisis can cause short-term ups and downs in the stock market, especially for fast-growing companies, it's important to remember a few things. First, always diversify your investments. Don't put all your eggs in one basket. Second, remember that despite challenges like this, the stock market has historically gone up. This is partly because of inflation. As prices rise over time, so do company values. The US debt crisis is a big deal, and it will keep influencing the stock market. Stay informed, understand what's happening, and make smart choices for your financial future. What are your thoughts on this? Has the debt crisis changed how you invest? Let me know in the comments below. And if this video helped you understand things better, please give it a thumbs up, share it, and subscribe for more insights. Thanks for watching.